How are you, folks? Enzo DiCostanzo, clinical professor, economics and finance in St. Peters, Jersey City. And today, this sort of came to me this morning, which is why I like teaching and why I like doing the economic consulting work that I do. That it came to today. The Associated Press puts out a nice, succinct version of the economy. And I think I was looking at my spreadsheets from last year, and I saw how complicated, how long a lot of that stuff was. So I think what we're going to do is we're going to do almost like a newscast. Just do a real quick read through of the most important topics in the economy today, energy prices, things of that nature. But the Federal Reserve is going to do interest rates. Are we in a recession? Are we not in a recession? And we'll try to get a piece of this because next week we have a couple YouTube days, and actually in October, I think I said we were going to have a full three-day week in October. It might be just Wednesday, Thursday again. So for the guys at St. Peter, the St. Peter students, Mondays might be a YouTube. But we'll, like I said, hang on until I post that to Blackboard. Anyway, folks, let's do a share and let's take a good look at what I spoke about today. Like I said, I want this to go relatively quick. So. Okay, folks, here we are. So economists and Wall Street traders. So I feel like a newscaster on Fox News. Economists and Wall Street traders expect the central bank to raise the key interest rate, short-term rate, by 0.75 of a point for a third straight time. This would extend the most rapid series of rate hikes since Paul Volcker. And the European Central Bank is similarly doing that. They're increasing their interest rates. They have inflation issues. The economies, the European Union economy isn't doing as well. And again, for the folks in the international finance course, how many people use the euro? How many people are in the European Union? How many people the central bank of the European Central Bank covers? It's all different numbers. One of those numbers like 19. I think there's like 27 countries that use the euro, but only 19 of them are considered the European Union. And so it's that kind. It's a number. It's in the 20s. It's a number in the 20s. So for the international finance folks, you want to get on top of that. And also, just as we're sitting here talking, that we don't need. So let's take a look at just very quickly for Open Market Committee, the meeting schedule, what the calendar for this stuff is. This is the calendar. I didn't want the calendar. I wanted the meeting data is what I wanted. News and events. Let's do transcripts so you guys can see the schedule that they're talking about. It comes with the transcripts. Yeah, there we go. We're here, but there was here's meeting calendar right there. It's like I'm trying to find the enrollment services at school. So you can see January, March, May, June, July. So we have a September one. So we have a September, November, and December one. August is up in Wyoming. There's pictures up there of people with the buffalo or whatever, and some people seem very awkward. And you can see people are just living in which I include myself. I'm basically just a city guy myself. But you can see people out there. There's some people who are used to the wide open country, and some people who are not used to that. So anyhow, but so the European Central Bank. So we're looking at 3 more meetings now. This European Central Bank, I don't know what their schedule is, but actually, just as we're speaking here, I probably should just quickly look that up. ECB meeting. It's probably the same. I don't want to spend too much time. Rate setting ECB. So it might be this thing. Here it's the policy meetings. We really care about the policy meetings is what it is. So ECB meeting schedule. So maybe if we could filter this somehow, you're welcome. General Council meeting. We want to look for the policy meetings as we go through all of this. But okay, so this was in 23, 24. Okay, so it starts up here, and it's even. This is September 21st, the 22nd, October. So it looks similar. September, October, November. There's a monthly. Here we go. Policy. Monetary policy is there. Monetary policy is there. October, December. Yeah, right. They have the there's monetary policy meetings and non-monetary policy meetings. All right, and in 23, I don't know if the policy meetings are set up here for 23. Press conference, non-monetary. So yeah, so it'd be March is one. So you have to sort of string your way through it. February there's one. It doesn't look like January has one. It's a non-March, but the December has one. So again, we could put all those numbers together. But it seems like it's similar. Sorry, the ECB is having their policy meetings, and they're setting its key rate by 3/4. Also, yeah, for Mike and Pete, just concentrate on this page. I mean, if you want, you guys, I'll send this to you guys. If you want to dig into the rest of the details, folks, for the St. Peter's group, Mike and Pete are the guys I work with outside of the school. So yeah, so again, similar characterizations of the economy. We've got issues with inflation, issues with the economy. I probably should have bolded out record high. And then now getting back to the U.S., many economists say that the borrowing rates, as I'm saying, and this is true in the European economy, this is true in Africa, this is true in South America, all these different places. So as you're looking at this, and folks, stand by 1 second, because this thing will click. This thing is gonna beep at 10 minutes. I got to remember to get in there. So this is true anywhere. When borrowing rates appreciate or increase, employers cut jobs, consumers spend less. There's an eventual downturn in the economy. So when Jay Powell or these guys are telling you we're going to keep raising rates, you never would hear that in the 70s and the 80s. Absolutely never. You would never hear Alan Greenspan, who for 25 years telegraphing what he would do. Alan Greenspan says, here, the Queen of England passed away. God bless her soul, passed away today. Pope John II was Pope for, I don't know, 30 years almost, I think, almost 30 years. Yeah, 77, 87, 97. Yeah, 206, almost 3 decades, John II. Benedict was Pope for maybe only about 10 years, and Francis has been Pope for about 10 years. So those are similar years. But yeah, so but Volcker would, I'm not Volcker, Greenspan would never, and maybe even Volcker too. It just wasn't the custom to disclose. But after the financial crisis and things of that nature, we're continuing to see people, we're continuing to see the central banks want to communicate a little bit better with the public. But like I said, in terms of why recessions happen or why economic downturns happen, right there, increasing rates, employers cut jobs, consumers spend less. That's why you have a recession, or worse. Larry Summers, one of the Obama guys, and I actually Obama, even Clinton, Obama, he was that side of the aisle. He thinks unemployment rate now at 3.5% might have to reach 7.5% in 2 years to reduce inflation to close to the Federal Reserve's 2% target. That's a big number. And I've heard discussions about the interest rates. This is about the employment rate, but I've also had people say, hey, you have to have a federal funds rate that's above what you want your inflation rate to be. So, that's why the Jamie Dimons of the world and the Bank of Americas of the world are saying the things that they're saying. For the year, the S&P 500 down 15%, the Dow is down 12%, the Nasdaq down 24%, the Russell 2000 down 17%. And it's funny, I was scurrying around my folders looking for my what do you call it? I was looking for my statistical analysis when I from last semester, where I taught what the Nasdaq was, what the Dow Jones was, what the divisors were, those types of the actual mechanics of how all those indices are created. And I think we did a little computation. So I think I may have computed the Dow Jones with the Dow Jones divisor, but in a statistics class. So we're not going to go into the definitions because I just want to get the news out there. But that's also a valid thing in a statistics class. That's something you'd want to look at. Russia, the war with Ukraine, it's fueled inflation in Europe, with Russia sharply reducing supplies over cheap natural gas, use to heat homes, generate electricity. So yeah, here, so the natural gas that Russia supplies, folks, I apologize for that. The natural gas that Russia supplies is used to do all these things: generates electricity, operates the factories, heats people's homes, and I was on Fox News. I was talking about it with a relative of mine. We're looking at a 10% or more, appreciation, 10% more, 10 times. Forget about 10%, 10 times more appreciation in terms of the prices of natural gas. 10, not 10%, 10 times. So if it's $1 per BTU unit or whatever, whatever the cubic unit of natural gas is, it's $10. So if you go to and relating that to petroleum and to the refined gasoline that we buy at the gasoline pump, if it's $1 a gallon or $3 a gallon, now it's $30 a gallon. Just to put it in perspective, scary, right? The central bank made its largest ever interest rate increase to combat record inflation that's squeezing consumers and pushing the 19 countries that use the euro currency towards recession. So like I said, so there's various counts of who's in the EU and who uses the euro, but they're not in the EU. And like I said, those for the international finance guys, the 415 section, that's about, it's in the 20s. I think it's 27. I don't think it's 19. Or I don't know about that. The number of countries that use the euro. Well, let's do a quick check with that. Number of countries using, because I taught 415 a number of years ago, and yeah, see, there's some folks that are in Europe but don't use the euro, and oops, there it was. Stay on the call. Yeah, that's what I was waiting for. Sorry about that. Yeah, we could look at the world atlas very quickly. Yeah, so yeah, I knew it was going to be a paragraph thing. It wasn't, so okay. Yeah, there's eurozone countries. These are the eurozone countries. They don't all use the euro. And these are the biggest eurozone countries. Then there's countries that use that actual currency. And I was hoping for a better listing than that, which I didn't get. What is this? Who uses the euro? I should have had that sort of. There they go. There's all the countries, and then it says who doesn't use the euro, and then before and after. So you can see there's all sorts of lists as to who manages it, and where that public money goes, and those types of things. It's a spaghetti of places. So yeah, all right. It says, yeah, here we go. It says this is also of the European Union, which is 19 of the 27 EU members. Okay, the European Union. With 19 to 27 you're using the, okay, so there's 19 that use the euro, and there's 27 EU member states. So what did these guys say? Yeah, that might not be right. With 19 to 27 member states using, okay, 19, okay, yeah, so 19, yeah, 19 do use, there's 27 euro member states. Okay, well, and again, for the international class, you guys can dig into that, and you saw how I did that. You guys can look that stuff up on your own. And the next thing is years of soaring home prices, sharply higher mortgage rates remain hurdles for many would-be home buyers, with more homes selling for less than the asking price. So yeah, that's a big flip, where when the homes are starting to sell less than the asking price, and instead of having to overbid or bid over the posted price, now it's under that. So there's a seismic shift there. And Pete, the other night we were talking about the yield curve. We were talking about a couple different things the other night, the unemployment numbers, and we'll get to that in a different video. The housing market is becoming less skewed in favor of sellers, and more, and a little bit more advantageous to the buyers. But that's it. So for Mike and Pete, that's all I wanted to those are the main points here. I'll email you guys this PDF so you guys have it. But for the class, I want everybody to get through the rest of all these pages. But so what Powell is talking about here. But Pete, I'll send you guys the video link. I'll send you guys the PDF. But now the class, I want, I'm saying you guys listen as much as you want, but I want the students have to listen from here on out. The students have to listen. So the last time the Federal Reserve faced inflation as high as it is now is the early 1980s. It jacked up interest rates to double-digit levels, and in the process called a deep recession and sharply higher unemployment. And Jay Powell had some comments. He doesn't think the Fed's going to have to go as far. He says this is his quote. He goes, we think we can avoid very high social costs that Paul Volcker in the 70s and the Fed had to bring into play to get inflation back down. Powell said in an interview with the Cato Institute, referring to the Fed chair in the early 1980s, who sent short-term borrowing rates roughly to 19%, if you can believe it, to throttle punishingly high. That was great for the CD buyers, that's for sure. Making 19% on a certificate of deposit, that was fantastic. And here, and again, I didn't go through the definitions, but basically commercial banks lending their excess reserves to one another. That's what the federal funds rate is. The discount rate that you're borrowing directly from the Federal Reserve, which is a discouraged thing. And I think the discount rate is a little bit higher than the federal funds rate. So, and again, all of those rates, those sort of money rates, all the credit card rates and auto loans, certainly mortgages, and any sort of debt relies on these numbers. So as the federal funds rate changes, all the other interest rate instruments out there are certainly changing. So Powell again reiterated the Fed is determined to lower inflation, and we're looking at it is 8.5%. It's not zero, like the Biden press secretary said. Maybe the month over month change could be zero, but it's not zero from a year ago. But again, now look, this semester we didn't go heavy with the Excel. We're going to talk about the economy more. We're spending a lot of time on tax issues, so I'm not going heavy-handed with the Excel. But in past years, we've done a very thorough job of that. And also, just to mention this to my students, also the Fed meeting. That was the Fed meeting. But I want to show you guys here's the snapshot. And then again, I also taught some of this in previous years: inflation numbers, labor market. Some regional numbers here. This is about a 14-page. They call it the housing sector, business sector, households, economic activity, general overview. What the unemployment numbers were. And again, this is just looking at the last few. It only goes up to 15, so there's no recession in here. But you can see we're plummeting. Very low. Obviously, this was the COVID. You had the big spike in the unemployment rate. But this is something where I get this every month. The New York Federal Reserve sends it to me, but it's online too. There's no secret economic reports. All that stuff's online. But notice how here. Let's just look at the unemployment rate. The unemployment rose in August to 3.7%, up from 3.5% in July. The increase was driven by higher labor force participation, which means more people looking for a job. And we would go through all of the ratios, all the employment ratios, and how we compute labor force participation and unemployment rates and employed persons, unemployed persons, how you count that stuff. But again, that's a whole complicated dish of spaghetti. So the household survey measured the employment increase by about 300,000 people. And again, how many people live in this country, and how many people live in New Jersey, and how many people live in California, how many people live in New York State, and we were bandying those numbers around. But the labor force participation rate, it's really a combination of employed people looking for a job divided by employed, unemployed, and then not in the labor force. And then you can't count retired folks, you can't count very young people, and you can't count people in the military, and it becomes a very statistical discussion. Okay, but and also what I think that is, and okay, it was driven by higher labor force. So I would take that as an economic rationale, but it's a graph, a statistical analysis, and then a little bit of economic rationale. Is in here. That's how you, and again, there's a lot of these graphs. There's the PCE deflator, there's a gross domestic product growth, a manufacturing index, disposable income and consumption, and on, all these different things. But again, that's a course, just discussing all that. But that's something that I'll send some of that out to as we go along. So we're here, and says even so, he did not comment on what the Fed may do. At its next meeting in 2 weeks, economists and traders increasingly expect the central bank to raise its key short-term rate by another 0.75 of a point, 0.75%, which is almost a percent, for a third straight time. That would extend the most rapid series of rate hikes since Volcker's time. And again, it's back to that's the American central bank, and that's whatever the schedule that we looked at was. Or we had the schedule someplace, or wherever it was. I don't think it's any of these. Yeah, it's this thing. So the meeting here on the 20th. So about 10 days from now, there's most likely going to be another version of that. And again, so what are these guys trying to do? So the Fed benchmark rate affects many consumers and business loans. And I said that at the beginning of the video, which means the borrowing costs for the economy will likely keep rising. On Thursday, the European Central Bank increased its key rate. So they had their policy meeting in September by 3/4 of a point, the largest in its relatively short history, as Europe also struggles with record high inflation and stumbling economy. And also, folks, let's just quickly, I wanted to look at we had snapshots, disposable income, spending, business, housing, government spending. Here it is. See, this is the core inflation number. You take out food and energy from that, and I don't know if there's and that's going to be a little bit of a lower number and a little less volatile. So core goods, core services, the orange one or the yellow one is total core, but still you're still hovering around that 6, 7, 8% or so. This is core goods fell from 7.2 to 7. That softened a bit. And then core services inflation was unchanged with a rent inflation. So they have rent inflation, core services, core goods, and there's a couple different ways to measure inflation. There's a medical care inflation. There's there's some regional numbers here, some international stuff here, some the financial markets have showed up here, and also looking at these numbers. Implied federal funds rate. It says that the path of the federal has shifted upwards, which is true. And looking at this is based on the July meeting, based on the August meeting, and then based on the September meeting, and what we think the market implied federal funds rate is going to be. And again, you can see very similar numbers there. Like I said, I'll send this to you. We have the Treasury number here. Then there's some stuff from financial markets, dollar exchange, that stuff. Okay. I think, yeah, that's in a 40. But I just wanted to see, is there just a basic inflation one here? This is real GDP, unemployment. Yeah, the deflator. People use the deflator. It says the PCE inflation over the year fell from 6.8 in June to 6. So that's the year-over-year number. I don't think those. I mean, it could be. There's two ways to do this, to compute an inflation number. You can take this June from last June, a year ago, 12 months ago, or you could take this June relative to May and then do some math and turn it into a 12-year or 12-month number. So if you move, 0.1% from June relative to May, basically just multiply by 12, kind of a thing, and you get 1.2% for inflation for the year. You could do some geometric math, but I've just done the multiply by 12 maneuver. It's generally being pretty good. Or you could say something like this: it's a 1% month over month inflation change for the year, be 12, which would be really big. Ideally, that month over month inflation number, if it's about 1.5, I think that's pretty good. 1.5, 1.25%. I'm sorry, not 1.5. 0.15, and something that when you multiply it by 12, you get about 2 or so. That's really what you're looking at. So I would say about 0.15%, maybe 0.2% month over month changes, things. But again, I went through all these definitions, a couple of years ago, and I know it takes a lot of time, so I'm not going to just repeat, harping over that. So again, impacts consumer business loans, European Central Bank, they're going to make their changes. Bank of Canada lifted rates by 0.75%. Central banks around the world are scrambling to keep up with rising prices. The Federal Bank of Australia implemented it. So everybody's sort of doing the same thing here. Despite Powell's assurances, many economists worry the Fed will have to allow unemployment to rise much more than currently expected to get inflation back to its 2% target. And again, I think we're at the point in society where I don't say we don't trust our institutions, but I think we're looking I think we're looking twice and thinking twice when we're hearing, Jay Powell or I think any spokesman say, hey, things aren't so bad. But then you're getting economists who are looking at this, looking at it very quantitatively, saying, to get inflation back down to the 2% target, you're going to have to really slow down economic activity. And how are we going to do that? And by not having as much economic activity, you're not as many people are working. The house is flipped from going over the listed price to going under the listed price. That's a pretty dramatic inflection point. The Fed projected unemployment will rise to only 4.1% by the end of 2024 as higher rates bring down inflation. So Okay, but new research released Thursday under the auspices of the Brookings Institute says such scenarios are quite optimistic assumptions, and that the unemployment may have to rise much higher. So again, I didn't see what that paper was, but there's again another group of economists saying it's not going to just be 4% by the end of 24. It's going to maybe be a higher number. And we're looking at and Pete asked me this the other day. We were looking at how many years that we were going to be dealing with this. So we're looking at 2023, 2024 to still be impacted by the economic conditions that we have today. We're definitely looking at least another 2 years. That's for certain. Powell warned 2 weeks ago, the economic conference in Wyoming, that the Fed's inflation fighting efforts will inevitably bring some pain to households and businesses, but he had a failure to restore price stability would mean far greater pain. Price stability means the price is moving all over the place or moving too high by too much of a percentage change. On Thursday, he reiterated the Fed's goal to achieve a soft landing, in which it managed to slow the economy enough to defeat high inflation, yet not so much as to tip it into a recession. What we hope to achieve, the Fed chair said, is a period of growth below trend. Yeah, now a period of growth below trend, what he really means is we want to grow the economy very, very slowly. Trend is about 2% or 3%. So if we're below that, it's some number below that, whatever his models and what his thinking is telling him would be pretty good. I'd love to see economic growth around 2% and 3% or 2.5% or 3% or 4%, but that's gotten us to the high inflation place we are now. So maybe that's not going to help lower the price appreciation that we're seeing right now. So which will cause the labor market to get back into a better balance, and that will bring wages back down to levels that are more consistent with 2% inflation over time. Other Fed officials have echoed Powell's messages. We're not trying to engineer a recession. The Federal Reserve Bank of the president of the Federal Reserve Bank of Cleveland said Wednesday interview, and the Newswire, MNI, we're trying to engineer a slowdown or moderation of activity. I don't know what MNI is. At the same time, Mester, which is the president of the Cleveland Fed, acknowledged the Fed's rate hikes will likely lead to job losses and will be painful in the near term. Okay, so some of these other presidents, of the local banks, of the local central banks, are saying, chiming in with their opinion. And I'll tell you, to Jay Powell's credit, I've heard him at some of his press conferences say, his job was to gather all the opinions, not to make the opinion himself. And I hope that's true, because that's in my opinion, that's the best way to do it. But that may not always be politically so palatable. Leo Brainerd also remarked pointed out that there's signs that the supply chain snarls are easing, which could boost factory output and moderate prices. So we're getting a little better handle on supply chain. I'm not an expert at supply chain, but when I went to NJIT, I remember that was a big area. I didn't choose to go into it, but that's a whole supply chain management, and the models are involved in that. That's a whole mathematics, in and unto itself. That's not an accounting person. It's somebody who specifically studied supply chain. So anyway, in addition, she noted the automakers and retailers are enjoying hefty profit margins when goods were scarce and Americans were spending robustly. As consumers start to pull back in the face of high inflation, Brainerd said retailers and car companies may have to cut prices to boost sales. That would help slow inflation. Again, if people aren't spending as much and retailers want to sell cars and sweatshirts and sneakers and t-shirts and all those other kinds of things, as you just saw with house prices, you might have to start cutting prices a bit, which would help calm inflation down. I think this was one of the lines we posted at the beginning of this little discussion here. It says economists may say the borrowing rates keep rising, employers will cut jobs, consumers will slash spending. So this is sort of in one sentence how you kind of get to a recession, how you get to a downturn, basically. And some have issued starker warnings about the consequences of the Fed's aggressive pace of rate hikes. But I'll tell you, fast, big changes in interest rates are one of the things that cause recessions and cause economic slowdowns. Larry Summer, he was Treasury Secretary under Clinton. He thinks the unemployment rate now 3.5% will have to rise to about 7.5%. And think of the numbers that is. That's now, it's not out of 300,000 people, like I said in class, because like I said, you cut off younger people and older people, but you're still talking, what would that number be? So you're 300 million, 10% of that would be about 30 million or so, or let's say 200 million would 10% be 20. 10% of 200 million, about 20 million people, and let's say half of that. So you're still looking at millions of people, right, over a couple of years. That's never good. And those folks have to pay their rent and be able to exist. So, and then the new paper released Thursday conclude the Fed may have to lift unemployment rates as high as Summers has suggested to curb inflation. The research by Lawrence Ball, an economist at Johns Hopkins, and two colleagues found the pandemic has made the job market less efficient in matching unemployed workers with jobs, a trend that would accelerate unemployment as the economy weakens. So if you're not making those matches very easily, that also the whole system works less efficiently. Americans expect higher inflation over the next few years. Research found typically when that happens, employees demand higher pay, and their employers raise prices. So it's kind of one of those things where, and me and Pete were talking about this the other day, if there's a sentiment of something happening, that's almost, the psychological force is almost as powerful as any sort of dollar, capital forces or spending forces or anything like that. So again, employees demand higher pay, employers raise prices to make up for the increased labor costs, thereby fueling inflation. As prices accelerate, the Fed feels pressure to step up its rate hikes, putting the economy at further risk. It says not all economists accept the darker scenario. And again, nothing against whatever, Morgan Stanley, whatever it might be. But I would always take with a grain of salt any economist at any specific bank making some sort of prognostication on, or making some sort of projection on how the economy is going to do, how inflation is going to do. Warren Buffett, all these guys, everybody's got their angle, and they're going to use, if you work for a big financial firm, you're going to take advantage of that platform, that soapbox. Say, oh yeah, we think this, we think that, and then magically hoping that'll make that, encouraging signs of a soft landing is still possible. Well, we'll see, but and then again, the same economists cited slower economic growth, a decline in the number of job openings, a downshift in hiring, a drop in prices of oil and other commodities as factors that could lower inflation in the. And again, so what's going to lower inflation? Well, less economic activity, less open jobs, less hiring, oil and commodities, those prices dropping, all of that kind of thing is going to move. All that kind of stuff is going to move prices. Anyway, as I was looking through this, I probably should have highlighted maybe prices. I probably should have highlighted hiring and whatever, but that's fine. We can get to that another time. And here, some of the stock indices. And again, the main thrust or the main economic force that impacted the S&P and the Dow Jones Industrial Average and those types of those types of composites. It says, well, the European Central Bank made its largest ever rate increase. So the interest rate policy in Europe, which is as big of an economic area as America, in line with the U.S. Federal Reserve's moves and other central banks to fight inflation. And it says Jay Powell reaffirmed the Fed's commitment to keep rates high until the job is done in getting inflation under control. And so the impact on the financial markets. So this is for the week, right? I'm saying no. This is Thursday. Yeah, this is the starting price. These are the closing percentage changes for Thursday. 0.7%, 0.6%, 6 cents. Generally though, you're going to have a movement in stock indices on the day about 0.5% to 1%. If anyone tells you there's going to be some sort of astronomical number out there, a big change in something, I would really try to dig into why someone's telling you that. Okay, but if something moves, on the day plus or minus 0.5%, and all of these are in line. So this is the daily percentage close for all of these indices. This is for the week. They're all up about 2% or so, and now if that happened, just think about it. If that happened every week, you'd be up, whatever, 100% for the year. So this is a pretty volatile, week or so. Again, anytime you get guidance on interest rates, you get guidance on where you think the economy is going to go, you're going to have sort of a settling down of the market and a little more confidence where at least there's some sort of direction finder, there's some sort of radar, there's some sort of arrow pointing you as to where the people who really think about these markets, where things potentially are going to go. So it might seem unusual. You're saying, hey, we're getting all this maybe unhappy news about the economy, but the stocks are, the indices are up, about across the board about 2%. But here's the real sort of teller of what's going on. You can have, I don't say irrational fluctuations, but you can have fluctuations on the day. You can have fluctuations for the week. But here's the real story. This is for the year. For the year means from January across the board, 15%, 12%, 24%, 17%. Okay, so all the indices are down. And like I said, I apologize for not defining I know there's some younger kids in my classes, but last year we spent a lot of time on Nasdaq and Russell and the Dow Jones. I'll get those notes and I'll try to post those on Blackboard. But you can see for the whatever it is, the 9 months of the year, the 8 to 9 months of the year, pretty big changes, right? Pretty dramatic decline in these, and it gives the number of. I look at the percentages. It's an index. An index it takes the economic activity and takes away the dollars, takes away the euros, takes away the number of workers, and just turns it into a number. And as that number goes up, it's good. As the number goes down, it's bad. Okay, that's basically what an index is. Some business highlights. So, folks, again, just bear with me as we get through these. We're almost on our last couple pages here. It says Powell higher rates are unlikely to cause a deep recession. So the last time the Federal Reserve faced inflation as high as it is now was the early 80s. This is a little bit of a repeat. It jacked up interest rates to double-digit levels, and in the process called a deep recession with sharply higher unemployment. Jay Powell suggested this time the Fed won't have to go nearly as far as Paul Volcker did in the 80s to bring into play getting inflation back down. And Powell said in an interview with the Cato Institute. So yeah, you guys have heard this already. So short-term borrowing rates were 19%, which is a big number compared to what they are. That 2.5% range or so to really reduce inflation 40 years ago. And that's what we learned from what we've done in the past. Stocks recover from a stumble on Wall Street on whatever day this was. This was Thursday reporting. It's a stocks recover from a midday stumble and higher, staying on track for the first weekly gain in a couple weeks. Well, yeah, that's why. So if the prices are bid down, you're still going to have that natural bounce back of people saying, hey, whatever stock I usually follow, the price is a little bit lower, so let me load up on a little bit of it. That's just the normal oscillations of the market. The S&P rose about 1% Thursday. The Nasdaq and the Dow Jones also ended up higher after bumpy rides. And again, you can have volatility in the day. Warren Buffett says it's nothing to worry about. Warren Buffett talks about that all the time. Interest rate policies were in the focus for, again, the European Summit. So you're hearing me repeat interest rate policy all over again. In line with moves from the U.S. Federal Reserve and other central banks to fight inflation. And Jay Powell reaffirmed we're going to keep rates high until it's done. We've heard that already. Yellen pushes Biden's economic plan, and they're more, again, she's saying she's more optimistic about the course of the economy. But once again, with the current administration, I don't know what we can really listen to, what we really can believe, from these folks, from this particular administration. And there's people, I don't have a big axe to grind with Janet Yellen, but there's people out there who really say, oh, she said this, she said that, and we feel like she's not really with it or whatever. She missed, some of the signs of the economy or different things that were going on. So, but she says, this is her quote, and she used to have Jay Powell's job at the Federal Reserve in Washington. She says she's more optimistic about the course of the economy than she's been for quite a while, and she says she feels like we're headed in the right direction. She visited Detroit as a part of a tour with a larger White House campaign to highlight new laws intended to help the economy, boost computer chip manufacturing domestically, lower prescription drug prices, expand clean energy, and revamp the country's infrastructure. We hope for all of that. If there's some sort of policy that helps those things happen, if it's Trump, if it's Biden, if it's Obama, if it's Clinton, I like that. Who does it doesn't do anything for me. If it's Hillary, if it's Bill, if it's Obama, if it's Trump, if it's his son, or whatever it might be. Okay, that does if this stuff is working, the economy is working, I'm a happy guy, basically. So few Americans apply for jobless aid. It says the number of Americans filing for unemployment benefits last week fell to its lowest level since May. Despite repeated attempts by the Federal Reserve to cool the economy and bring inflation under control, applications for jobless aid for the week ending September 3rd, which was a Saturday, fell by about 6,000 to about 222,000 for jobless aid. The Labor Department. So again, there's people who follow the folks who fill out those applications either online or maybe a piece of paper at their local Department of Labor office or whatever it might be. The first time applications generally reflect layoffs. The 4-week average for claims smooths out some of the weekly ups and downs, and they use a moving average and things of that nature. So a 4-week average, and it declined by 7,500 to 233,000. Hiring in the U.S. in 2022 has been remarkably strong, even though the country faces interest rates and rising interest rates and a weak economy. Well, I've mentioned several times in this video, and I've said it in class, I've said it to Pete and Mike personally, that as when the unemployment rate gets too low, that's generally a precursor to a recession. And I think I showed a graph of that recently. What you would want to do is you'd want to go to the Bureau of Labor Statistics website, and you want to go as far back as you can, just what the unemployment rate is, just sort of looking at it. It's called the BLS. Again, I don't want to spend an enormous amount of time on it, but just very quickly,